if you look at the week that was, were you surprised as how quickly fear can grip the markets? I know there's been perils to .com. I know there's been perils to some of the other bouts of volatility that we've seen. And it's unclear the catalyst of what that was and what that means for the next 6 months.
It reminds me, I mean, it does remind me of that period of time back then when we had the bursting of the dot-com bubble. Ultimately, there were some fundamental assumptions that had to be revisited. And the same has happened with the bond market. Big picture, we think we are in an environment where there's been a deterioration in the growth and inflation trade-off. You know, ultimately, we think that new ranges are required for bonds. And the last 2 years have really been about bond investors getting used to that fact and accepting that we're not going back to what was true the last 10 years. So whenever these fundamental assumptions get challenged, you know, it takes a while for markets to adjust, and that's why obviously we're seeing this bear market in bonds. The exact timing of it then varies, but yes, I mean, I think it's fairly typical of, as I said, ultimately a fundamental reevaluation of what the right level of long-term rates is, and ultimately what that means for bond markets in general.
So, Jen, how do you build a portfolio then? What are you constructive on at the moment?
Well, actually, I mean, I think there's still a role for bonds, but as a source of yield. I think that, you know, I was hearing earlier on your show that there was talk of the fact that for bonds to rally, you need equities to sell off. That's assuming that negative correlation that, again, we saw in the last decade works. Again, I think
assumption.
That's a massive assumption right there. I don't think we can buy bonds for their correlation benefits anymore, but the good news is they are providing yield, and that income in itself, in terms of its payoff, is diversifying. So, again, when 60-40 was invented, the classic balance fund, by the way, the correlation between bonds and equities back then was positive. So we're going back to the old reason for owning bonds, which is for income.